Hello and welcome. You're watching BTTV. I'm Tanya Aneja, and today I'm delighted to be joined by someone very special. We have with us Mr. Trideep Bhattacharya, who is the Chief Investment Officer at Edelweiss Mutual Fund. Thank you so much, first of all, sir, for taking the time out and joining us here on BTTV.
Thank you very much for inviting me.
So I want to begin by asking you about the new fund offer only. I mean, Edelweiss has launched multi-cap fund that includes large cap, mid cap, and small caps. And you have, I read your recent report, and you have mentioned, large cap as proven leaders, mid cap stocks as, emerging giants, and small cap as rising champions. So, if you can tell us the primary objective, of that multi-cap fund, and also tell us about the strategy behind, these large cap, mid caps, and small caps.
Sure. Apologies at first for a verbose answer, but I think the genesis of this comes from where we are in equity markets right now as we speak. Now, if you look at, let's say, the global macro today, I would say it's decidedly negative, given where the yields are, given the Chinese recovery has been slightly weaker, and also the fact that in Europe there is a bit of a conflict going on. So a net balance with macro being negative, and in the local macro we have national elections over the next 6 to 12 months. So macro, whether it is global or local, is negative. In that background, we have markets at 20,000, and we have seen a good amount of rally in mid and small caps, almost about 40 to 60% over the last 3 to 6 months. So in that context, in my opinion, and when we sat through and decided what sort of fund would be the best fund for investors in the current scenario, we thought a balanced portfolio, well spread across large, mid and small capitalization stocks, is a good way of going about it. Also, after having seen a good amount of rally of about 40-60% in mid and small caps, there could be some pockets of irrational exuberance in some of those categories. So, by going with a balanced approach, we are balancing the risk-reward balance in such a way that overall it works in favor of investors over the medium term. So, hence the launch of a multi-cap fund, which we thought was the best possible scenario for investors in the current times. In terms of how we plan to sort of go about running this fund, I would say something like this: that overall it will be a fund which will broadly have about 40% large cap stocks and about 60% mid and small cap stocks. Okay. So it's well spread across large, mid and small capitalization stocks. So investors would not only get to play the upside momentum in the case of India for the next 4 or 5 years, but at the same time, we'll have the balance or the safety factor of investing in large caps, given how the near-term volatile macro conditions that we are facing at the moment. So it's a mix of defense as well as offense, and I think it's a good way to go in the current market scenario.
Okay, absolutely. And you talked about small and mid-cap stocks. Mr. Bhattacharya, we have seen, that the broader markets have had a stellar run. I mean, hitting all-time highs on a daily basis, especially, some of the sectors like defense, railways, PSU. So these stocks have performed really well. So do you think, now is the time to really rebalance the portfolio? And do you think that the space is a little overheated right now?
So that's what I summed up saying that, certain pockets of mid and small caps are witnessing a bit of irrational exuberance. And hence the need of the hour is to have a balanced portfolio across large, mid and small cap names. So imagine a portfolio which is 100% comprising of mid and small cap stocks. Now let us say there is a bit of irrational exuberance in maybe 20 to 30% of the mid and small cap space. And from an understanding standpoint, imagine that 30% of mid and small caps is being replaced by our exposure in large cap, which probably have better risk-reward balance. So in this way, we are being selective while investing in mid and small caps, but by not going overboard in areas where there is irrational exuberance, but at the same time investing in equities in the form of large caps, and over a period of time, the investors not only get a balanced exposure, but also get to see the upside in the right amount of stock or the right quality of stocks across market cap categories.
Okay, absolutely. And now talking about, some of the themes, because I think every investor wants to know the themes that could actually give a good amount of return for, let's say, 12 months, 1 year, 2 year, 3 year period of time. So I want to know it from you because I saw some banking and IT names in your large cap universe. So which themes you are bullish on at this point in time?
So overall, I would say that I started off our conversation saying that macro is decidedly negative,
Yes.
and hence focusing on macro and investing based on the same is extremely difficult in the current circumstances. So what we have done and what we plan to do in the multi-cap portfolio is to orient our portfolio towards what we call as pockets of earnings resilience on a bottom-up basis.
Yes.
These are the areas where we think have special tailwinds going for them on a bottom-up basis, either from a sectoral standpoint or from a regulatory standpoint or from a country-specific standpoint. As a result of this, even in a volatile macro conditions, these are the areas or these are the stocks which are exposed to these areas. They would have resilient earnings relative to the broader market. That's the thinking behind it. So having said this, we identify basically 5 areas of earnings resilience, which will comprise almost about 70 to 75% of the multi-cap fund and also represents our view in general across other funds as well. These 5 areas are: first, we expect a manufacturing upcycle driven by private sector capex to be well spread out over the next 3 to 5 years. Okay. We are well in and we have good room to go, and hence a strong area of earnings resilience. The second area, as you alluded to, is what I would call as lending financials, whether it's bank or NBFCs. I think from a near-term standpoint, which is a year or so, we think that this is as an area where credit growth is also strong and asset quality worries are not there. So ideally, an ideal condition to be a bank or an NBFC. So a second area of earnings resilience. The third area that I would point to is real estate. In my opinion, we are in the middle of a 5 to 7 year upcycle in real estate, where we have first 2 or 3 years have gone by, and there is a good runway ahead of us. Okay. The fourth area I would allude to is basically indigenization of defense, wherein I think the visibility in terms of orders for the companies is not the problem. The problem is how they will execute it. So as long as we do a good job at stock picking, that's another area of earnings resilience. And the final area I would point to is EMS, or electronic manufacturing systems. Okay. I think this sector is going through its own IT services moment at the moment. I think as long as the policy tailwinds are there, this could last long. The sector itself is growing at the rate of 30%, and with a bit of stock picking, we can do better than that. So net, in and around these 5 areas of earnings resilience, we think that companies have strong tailwinds. And orienting a portfolio around these areas, we can put together a bunch of names where the blended growth of the portfolio could be about 20 to 25% without overpaying in terms of valuations. Right. So we think that markets from that standpoint still is good enough for stock picking.
Okay, absolutely. Very well explained, Mr. Bhattacharya. And coming to your recent note only, I mean, I read that you mentioned India has a lot of opportunities, right? And we have had a stellar first half of the year. But if you look at the situation right now, we have escalating geopolitical tensions in the Middle East. So I want to know it from you that what should be the strategy now for the investors? And do you think there could be a major correction happening going forward?
I would say that overall, yes, macro has gotten tougher, which is how we started our conversation. And it's gotten tougher because of US 10-year bond yield reaching levels which we last saw in 2007, and also geopolitics on net balance becoming a little more troublesome than what they are, what it has been in the past. I would say that India has always been a bottom-up market, or what we call as a stock pickers market. I think if we get the right stocks in the right sectors, which are the 5 areas that we talk about, it's always kind of good despite troublesome macro. We have kind of dealt with situations like this in the past, and I'm confident that we will kind of continue to do so over the medium term going forward as well. The thing to keep in mind is that at the end of the day, our direct interaction with some of these global areas is limited. India is by and large a domestic economy driven rather than export driven. And that to a certain extent in such conditions of macro insulates us to a certain extent. I'm not saying that we would be completely insulated, but to a certain extent it makes our earnings story a little more resilient than the rest of the world. And that's what India has been, an island of hope in troublesome macro right from the beginning of this year. We think that will continue. We will have our share of volatility as we go through the period of our own national elections and also regional elections, which are right in front of us. But I think that would be more like a storm in a teacup rather than a tornado.
Absolutely, well said. And now coming to the earnings only, because it's the earnings season. So what are your expectations from September quarter earnings? Any surprises that we can expect? And any sectors that can deliver, healthy earnings growth?
So I would say that this quarter, which is the September quarter, which is right in front of us, would be marked by, at an India Inc. level, margin expansion. And this margin expansion would be mostly driven by the fact that commodity prices from a year-on perspective have actually come down. And that will boost the earnings overall on a relative basis versus that of top line. So if you look at any broader index like Nifty 50 or BSE 200, I would probably expect somewhere between 5 to 10% revenue growth, but earnings growth to be anywhere between 30 to 40% Y on Y. And that is mostly driven by the margin expansion that I was alluding to. Now, amongst sectors and themes that would do well, I would think that the September quarter results on net balance would look as if a step forward for manufacturing side of the economy, and maybe kind of okay to marginally weak or to one step backward for the consumption side of the economy. And that's how our portfolios and our thinking is oriented at the moment.
Okay, absolutely. And, TCS reported muted numbers. And when we talk about IT stocks, street is divided. Some say there is more pain ahead. Some say, no, the pain is over. What are your thoughts? And, I want to know it from you that what are your thoughts on mid-cap IT also? Do you think mid-cap IT can outperform large-cap IT stocks?
So I think overall IT services, I would say that it went through its heydays when we were all shut down during COVID. Had a period of earnings normalization over the last 12 to 15 months, and now is going through the impact of weakening or weak global macro conditions, particularly in the United States. Yeah. So putting all of these in the form of view on IT services, we have been massively underweight by almost about 300 basis points in IT about a year or so ago. From there on, we have actually moved to neutral position as of now in our portfolio. So on net balance, incrementally we have turned more positive. But it is not an area where we would tom as an area of earnings resilience, because I think we still have a few more quarters of earnings rationalization in sync with the global economic conditions to come through. So from a year's time, maybe things would get better, but not yet, and would happen more slowly than what people anticipate. And TCS results and many other results that we will see is symptomatic of the fact that growth is a little anemic, even though the signings have been robust. The future is positive, but the immediate short term is impacted by the global weakening macro conditions.
Okay, got it. And lastly, Mr. Bhattacharya, if I want to construct my portfolio at this point in time, what should be the right approach? And if you could also talk to us about, asset allocation strategy as well.
So I think at the moment, as we started this conversation with, and I would say the same thing to yourself, that today, if I were to put incremental money to work, it will probably be in a balanced portfolio, well spread across large, mid, and small. And in that context, a multi-cap fund is a good way of constructing the portfolios from an equity standpoint at this point in time. We think that it's a relatively newer category launched by SEBI of late. But what is interesting to note is that this multi-cap as a category, if you look at returns per unit of risk taken, that is actually meaningfully higher than many other categories. So on a risk-adjusted basis, multi-cap as a category is a very good option for investors like yourself to sort of bet on. Multi-asset is another kind of way of approaching the same way across asset classes, and we think that certainly has a room in the asset allocation for investors overall. But from a medium-term standpoint, I think we are in an inflationary world. And in an inflationary world, equities should be a meaningful part of investors' portfolio over time. And within that, multi-cap fund should be a good way of approaching this.
Okay, absolutely. And lastly, just one last question. Any mistakes that investors should avoid, especially at this point in time?
I think the biggest mistake that there are two. First, I think a lot of debate usually goes on trying to time the market. Whereas we know the well-known adage, which is time in the market is a lot more important. So rather than thinking about the near-term correction, which may well happen, one should think about 5-10 years.
Yes.
And this is certainly India's decade. And hence, from that standpoint, one shouldn't miss out the medium-term upside in the wake of maybe a 5 to 10% correction in the near term. That's the first mistake or behavioral bias that I would recommend investors to sort of steer clear from. Second, I would say that not to invest based on the recent fad, which is basically something which is very informed, and I'm looking at multiple, whether it's cryptocurrencies, whether it's something else. Usually, the best time to invest is when there is a famine outside, because that's when you get the best valuations, and the time to reap is usually the times when there is a feast outside. As long as one maintains that behavioral sort of balance, I think investors should be good to go, particularly from an investing standpoint.
Absolutely. Golden words coming in. And on that wonderful note, thank you so much, sir, for taking the time out and sharing these wonderful insights with us.
Thank you.
Thank you so much.
If you like the video, do like, comment, share and subscribe.